Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we'll be discussing one question of cost sheet based on installed capacity of production where we allocate variable overheads. What is installed capacity? Installed capacity means, for example, in a classroom there is an arrangement of benches where at a time we can accommodate 100 students. If we can accommodate 100 students in that particular classroom, then installed capacity is 100 student is considered. If I say that 50% capacity is used, means in that case there will be 50 students who are attending the lecture in that classroom. If I say 25% capacity is used, that means 25 students have attending the lecture. That is the meaning of concept of installed capacity. In relation to production, it will be in terms of units produced. For example, installed capacity is 1 lakh units of shirts per month. That is installed capacity. If I produce only 50,000 shirts, then it will be said that I am using 50% of installed capacity. As installed capacity is differing relating to output, accordingly variable cost, fixed cost may also vary. That we are going to understand in this sum. Let us read the question. Vaidyanath Polymers manufactures and sell typical brand of tiffin boxes under its own brand name. The installed capacity of the plant is 1,20,000 units. Installed capacity is 1,20,000 units. That means 100% capacity is 1,20,000 units. That is given per year. So we can find out monthly capacity. Per annum capacity is 1,20,000 units divided by 12. So per month installed capacity is 10,000 units. Distributable evenly. The word evenly means it is same, it is equal for every month over each month of calendar year. The cost accountant of the company has informed you about the cost structure of the product. Cost structure means different elements of cost, which is as follows. Raw material rupees 20 per unit. This is the information of direct material per unit. Direct labor is rupees 12 per unit. This is the information of direct wages or direct labor. Direct expenses rupees 2 per unit. This is the information of direct expenses. Variable overheads rupees 16 per unit. So that is the information of variable overheads. Here all these expenses are given per unit. That means they are totally variable. These three expenses, direct material, direct labor, direct expenses and variable overheads, these will be called as totally variable expenses. Fixed overheads for the year, it is given rupees 3 lakhs. So it is fixed cost for the full year. We can get monthly fixed cost by dividing it by 12. Semi-variable overheads are as follows. So what is semi-variable overheads? Semi-variable overheads means they are partly fixed and they are partly variable. For example, in case of electricity bill, even though we don't use electricity for a full month, still we get a bill of minimum amount that may be of 100 or 200 rupees. So that is called as what? Fixed cost of electricity. As we increase electricity consumption, our electricity bill increases. That is the variable portion of our electricity expense. So that is an example of semi-variable overheads. Whereas here it is, they say rupees 7,500 per month up to 50% capacity utilization. Additional 2,500 per month for every additional 25% capacity utilization or any part thereof. What it mean? Additional 2,500 per month for every additional 25% capacity utilization or part thereof. What it mean? In this case, semi-variable overheads are charged like this: 0 to 50%. It is rupees 7,500 per month. That means if we use 1% capacity, variable semi-variable overheads will be 7,500. If we use 5%, 10%, 40%, 45%, up to 50%, it is going to be rupees 7,500 per month. If we increase capacity by 25% more, that means more than 50%, up to 75%, our semi-variable overheads will increase by, if we increase from 51% to 75%, our semi-variable overheads will increase by 2,500. That means 7,500 plus 2,500, it will be 10,000. That means if I use 55% of installed capacity, 60%, 70%, it is going to remain rupees 10,000. If we exceed this 76% up to 100%, additional 2,500, that is 10,000 plus 2,500, it will be 12,500. So if I use 80%, 85%, 95%, semi-variable overheads will be 12,500. This is what it is changing, varying as per the capacity utilization. The plant was operating at 50% capacity during first 7 months of the calendar year 2013 and at 100% capacity in the remaining months of the year. In a year of 12 months, first 7 months capacity was used 50% and next remaining 5 months capacity was used 100%. Total capacity is 1,20,000 units per annum. Per month it is 1,20,000 divided by 12, it will be 10,000 units per month. Now when 50% capacity is used, output will be 10,000 multiplied by 50%, 5,000 units per month. During first 7 months, 50% capacity is used. So during first 7 months output will be 35,000 units. Remaining 5 months 100% capacity, 100% capacity. Per month capacity is 10,000 units per month. 100% capacity for remaining 5 months multiplied by 10,000 units, it will be 50,000 units. So firm will be producing during first 7 months 35,000 units and next 5 months production will be 50,000 units. Let us consider now semi-variable overheads. During first 7 months 50% capacity is used and next 5 months 100% capacity is used. As per the information in the question, if it is up to 50% per month it will be 7,500 and if it is 100% it will be 12,500. Accordingly, accordingly, during first 7 months 7,500 per month multiplied by 7 months, it will be 52,500. Next 5 months, due to 100% capacity utilization, it will be per month 12,500. 12,500 multiplied by 5 months, it will be 62,500. The selling price for the period from 1st January 2013 up to 31st July, that is first 7 months, was fixed at rupees 69 per unit. The firm has been monitoring the profitability and revising the selling price to meet its annual profit target of rupees 8 lakhs. That means there is possibility that during first 7 months selling price is rupees 69. Next 5 months selling price may be changed because company want to ensure profit target as it is given here rupees 8 lakhs. You are required to suggest the selling price per unit for the period 1st August to 31st December, that is the next 5 months. Prepare cost sheet clearly showing total and per unit cost and also profit for the period first 7 months and the next 5 months. We have opened a cost sheet in two parts, first 7 months and the next 5 months, rupees and per unit column. During first 7 months there is output of 35,000 units. During next 5 months there is output of 50,000 units. First item will be direct materials consumed. In question they have given raw material consumed rupees 20 per unit. During first 7 months output is 35,000 units multiplied by 20, we can get direct material consumption rupees 7 lakhs. Similarly we can calculate for the next 5 months. It is rupees 10 lakhs for the next 5 months. Direct labor rupees 12 per unit. During first 7 months it will be 4,20,000. During next 5 months it will be 6 lakhs. Direct expense rupees 2 per unit. It will be 70,000 for first 5 months and rupees 1 lakh for next 7 months. We can add all these values to get prime cost. During first 7 months prime cost is 11,90,000 per unit rupees 34. During next 5 months prime cost is 17 lakhs per unit, it is rupees 34. To this we are going to add overheads. First, variable overheads which are completely variable. Variable overheads rupees 16 per unit. During first 7 months it will be 5,60,000. During next 5 months it will be rupees 8 lakhs. Now let us add fixed overheads. Fixed overheads they have given rupees 3 lakhs for the period of full whole year. Fixed overheads will be allocated on time basis, that is 7 months and 5 months. During first 7 months it will be rupees 3 lakh multiplied by 7 by 12. During next 5 months 3 lakh multiplied by 5 by 12. First 7 months fixed cost is 1,75,000. Next 5 months it will be 1,25,000. To calculate, we have to divide by unit produced. 1,75,000 divided by 35,000, per unit it comes rupees 5 per unit. Next 5 months 1,25,000 divided by 50,000 units, it comes rupees 2.50, 2 rupees 50 paise. Now third, we are required to add semi-variable overheads. Semi-variable overheads, we have done the working note. First 7 months it will be 52,500. Next 5 months it will be 62,500. It will be per unit 1 rupee 50 paise during first 7 months, 1 rupee 25 paise during next 5 months. So we have recorded all overheads, we can add them to get total cost. We have obtained total cost or cost of sales. We have now selling price for the first 7 months. It is given in the question that selling price during first 7 months, January to July, is 69 per unit. Accordingly, we can calculate sales for the first 7 months. Now we can get profit as a balancing figure. Total sales we got 24,15,000. So during first 7 months, company's profit is 4,37,500. Per unit it is rupees 12.5. Company has kept target of profit. The firm has been monitoring the profitability and revising the selling price to meet its annual profit target of rupees 8 lakhs. So here company has earned 4,37,500 during first 7 months, but it want to achieve target of 8 lakhs. So from 8 lakhs we will be deducting this profit. It means company must earn profit of 3,62,500 during next 5 months so that it can complete its target of 8 lakhs. So this profit will be added to total cost of next 5 months to arrive at sales figure. So during next 5 months, selling price will be rupees 61 per unit to arrive at sale of 30,50,000. There will be reduction in profit. It will be 7 rupees 25 paise during next 5 months. This is how we have learned how to install capacity based semi-variables are allocated and profit target is adjusted by the company. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.